On December 27th, 2025, Elon Musk posted 3 words to X: "This is not good." He was responding to China's announcement of silver export licensing requirements set to begin January 1st, 2026. 20 hours later, the CME Group raised margin requirements on silver futures contracts from $20,000 to $25,000. 48 hours after that, COMEX registered inventories dropped by 60% in a single month. Today is January 3rd, 2026. Licensing has been active for 72 hours. Physical silver is trading at $130 per ounce in Tokyo and Dubai. The paper price on Western exchanges shows $71. That is an 82% premium. This has never happened before in modern commodity markets. Here is what that divergence means. For 5 decades, the price of silver was determined in futures markets. Traders bought and sold paper contracts backed by a fractional amount of physical metal held in approved vaults. The system worked because most contracts settled in cash. Physical delivery was rare. The ratio of paper claims to physical inventory remained stable, somewhere between 50 and 100 to 1. That ratio no longer exists. As of December 2025, COMEX held 47.6 million ounces of registered silver available for delivery. Outstanding futures contracts represented 16.9 billion ounces of silver. That is a paper-to-physical ratio of 356 to 1. Every ounce of deliverable silver has 356 claims against it. When Musk said, "Not good," he was not speculating. Tesla uses silver in every vehicle it manufactures. Electric vehicle battery systems require between 25 and 50 grams of silver per unit for connectivity in control modules and charging infrastructure. Solar panel installations use 20 grams per panel. Semiconductor manufacturing for AI data centers consumes silver at the wafer level. These are not discretionary uses. There is no substitute for silver's electrical conductivity at the current price point. China refines 65 to 70% of global silver supply. Most of this is not mined directly. Silver is a byproduct of copper, lead, and zinc mining. When those operations slow, silver supply contracts. China's export licensing does not ban shipments. It requires government approval for each transaction. Only large, state-controlled firms with annual capacity exceeding 80 tons received licenses. 16 companies made the list. All are domestic-focused. The effect is mathematically straightforward. Western manufacturers who relied on Chinese refined silver now compete for the remaining 30 to 35% of global supply. That supply was already in deficit. The Silver Institute projected a shortfall of 117 million ounces for 2025. This marks the 5th consecutive year of supply deficits. Industrial users are not price sensitive in the way retail investors are. A solar panel manufacturer cannot halt production because silver costs 15% more. The panel still requires silver. The customer has already placed the order. The factory must source metal at any available price or default on contracts. This is inelastic demand. In late December, physical premiums in Shanghai reached $8 per ounce over London spot prices. By January 2nd, that premium had expanded to over $50 in Asian markets. Buyers are bypassing exchanges entirely. They are contracting directly with miners or purchasing from secondary dealers who hold physical inventory. The screen price no longer reflects acquisition cost. On December 29th, the CME raised initial margin requirements on March 2026 silver contracts to $25,000. This represented a 13.6% increase. 2 days later, on December 31st, margins were raised again to $32,500. That is a 62% increase in 72 hours. Margin increases are presented as risk management. The exchange claims it must protect the clearinghouse from volatility. This is correct in mechanism, but incomplete in implication. When margin requirements rise, traders must post additional capital or close positions. Retail traders with limited capital are forced to sell. This creates downward pressure on the paper price even as physical demand accelerates. The entities who benefit from lower paper prices are those holding short positions. A short position is a bet that prices will fall. If you sold silver futures at $80 and the price drops to $70, you profit $10 per ounce. But if you sold silver you do not own, and the buyer demands physical delivery, you must acquire that silver at the current market price. If physical silver trades at $130 and your contract obligates you to deliver at $80, you lose $50 per ounce. JP Morgan, HSBC, and Bank of America are the largest holders of short positions in silver derivatives according to CFTC bank participation reports. These institutions act as market makers, hedging client demand and managing their own books. When physical premiums decouple from paper prices, their exposure becomes structural. They cannot deliver metal they do not have. The margin hikes force liquidation of long positions, temporarily suppressing the paper price and creating a window to cover shorts before the physical shortage becomes unmanageable. This is not speculation. It is position management under duress. COMEX inventories fell by over 60% in December. That is 47.6 million ounces removed from registered vaults in 30 days. The decline was not gradual. It accelerated in the final 2 weeks of the year as industrial buyers moved to secure metal ahead of the Chinese licensing deadline. In a functioning market, falling inventories signal rising prices. In this market, falling inventories coincide with forced selling driven by margin policy. The contradiction exposes the structure. Paper contracts are pricing mechanisms, not delivery mechanisms. When delivery is demanded at scale, the system fractures. Tokyo reported physical transactions at $130 per ounce on January 2nd. Dubai confirmed similar levels. These are not isolated trades. They represent institutional offtake agreements for tonnage-level purchases. A semiconductor manufacturer securing supply for Q1 production cannot wait for COMEX to resolve its inventory problem. They pay the physical premium or halt operations. This is the crisis Musk referenced. Not the price, the availability. Silver miners are the primary beneficiaries. First Majestic, Pan American Silver, and Wheaton. Precious metals sell physical production. If the physical price is $130 and their cost of production averages $18 per ounce, their margin per ounce is $112. Equity valuations adjust accordingly. These companies are beginning to bypass benchmark pricing and negotiate direct sales at physical market rates. This shifts cash flow projections and re-rates the sector. Silver ETFs face a credibility test. The iShares Silver Trust holds approximately 600 million ounces. The ETF is structured to track the spot price of silver. But if the spot price is $71 and physical silver costs $130, the ETF holds an asset worth nearly double its net asset value. Retail investors who own shares cannot redeem them for physical metal without meeting minimum thresholds and paying premiums. Institutional investors can redeem, but doing so drains the ETF's inventory, forcing additional purchases in a market with limited supply. If redemptions exceed availability, the ETF may suspend creations or trade at a discount to its supposed holdings. This has already occurred in nickel markets. In March 2022, the London Metal Exchange halted nickel trading after a short squeeze caused prices to spike above $100,000 per ton. Positions were retroactively canceled. The market did not reopen until forced liquidation of shorts was negotiated. Silver is larger, more distributed, and more critical to industrial supply chains. The CFTC opened investigations into silver manipulation in 2008, 2010, and 2013. Each was closed without enforcement. The claim was always the same: concentrated short positions held by a small number of banks distorted price discovery. The counterclaim was that these shorts were legitimate hedging activities. Whether the shorts were manipulation or risk management, the outcome is identical when physical demand exceeds available supply. The shorts must cover or default. If COMEX declares force majeure and suspends physical delivery, the paper price loses its reference. Futures contracts settle in cash based on a price that no longer reflects physical reality. This would effectively end the paper silver market as a global pricing mechanism. A new system would emerge, likely centered in Asia, where physical flows dominate. China's licensing policy is not temporary. It is strategic. The nation is securing silver for domestic industrial use. Solar panel manufacturing, EV production, and technology fabrication all require consistent metal supply. By controlling exports, China ensures its manufacturers are not competing with foreign buyers for the same inventory. This is the same playbook used for rare earth elements. The United States designated silver as a critical mineral in 2023. This classification allows government stockpiling and prioritization of domestic supply chains, but domestic mine production accounts for roughly 5% of global supply. Even with increased exploration and development, it takes years to bring new mines online. Silver is predominantly a byproduct. You cannot simply dig more silver. You must mine more copper, lead, or zinc, then refine the silver as a secondary output. The 5-year deficit means inventories have been drawn down for half a decade. COMEX registered stocks are 70% below 2020 levels. LBMA vault holdings have declined materially. Shanghai inventories are not publicly reported, but are understood to be at multi-year lows. There is no strategic reserve waiting to flood the market. The feedback loop is mechanical. Physical shortages drive industrial buyers to secure long-term supply contracts. This removes metal from the spot market. Reduced spot availability increases premiums. Higher premiums attract speculative demand from investors, who recognize the arbitrage. Speculative demand adds to industrial demand. The paper market cannot suppress physical reality indefinitely. The weak point is the clearinghouse. COMEX must guarantee every trade. If a seller fails to deliver and the buyer demands metal, COMEX must source that metal or settle in cash. Cash settlement at the paper price when physical costs 80% more is a default by another name. The clearinghouse is backstopped by member banks. If the banks cannot meet their obligations, the exchange faces systemic risk. This is not a prediction. It is a sequence. Each step follows from the conditions now visible. Retail investors who bought silver at $30 per ounce now hold an asset the market values at $71 on paper and $130 in physical form. But they cannot sell at $130 unless they hold physical coins or bars and find a buyer at that price. Most hold ETF shares or futures contracts tied to the paper price. The wealth exists in theory. Accessing it requires physical delivery, which is constrained. Manufacturers who delayed silver purchases to avoid high prices now face a choice. Pay $130 per ounce or shut down production lines. A solar panel company with contracts to deliver 50,000 panels in Q1 cannot renegotiate the deal. It must source 1,500 kilograms of silver at current rates or default. That is $1.3 million in additional input costs if the price holds. If the price rises further, margins collapse. The Chinese licensing system is not designed to crash markets. It is designed to secure supply. But securing supply for one nation means restricting it for others. The rest of the world must now function with 35% of previous supply at a time when demand is increasing. This is the condition Musk identified as not good. It is precise language, not catastrophic, not speculative, just not good. The severance between paper and physical prices indicates the end of a pricing regime. For 50 years, futures markets set the global price of silver. That system depended on fungibility between paper and physical. When paper no longer converts to physical at the quoted price, the paper price becomes informational but not transactional. The transactional price is what you pay to acquire deliverable metal. The price is now set in private negotiations, direct miner contracts, and Asian spot markets. Western exchanges will adjust or become irrelevant. The adjustment may involve higher margin requirements to limit leverage, restrictions on speculative positions, or changes to delivery terms. The irrelevance occurs if industrial buyers abandon the exchange entirely and source through bilateral agreements. Once that shift is complete, COMEX becomes a residual market for financial speculators, disconnected from the physical commodity it claims to represent. The timeline for resolution depends on three variables: Chinese export policy flexibility, inventory restocking speed, and industrial demand elasticity. If China opens licensing broadly, supply pressure eases. If inventories rebuild through increased mining output, the deficit narrows. If industrial demand slows due to economic contraction, consumption falls. None of these variables show near-term movement in the necessary direction. Musk's warning was not about the rally, it was about the consequence of the rally. Higher silver prices increase input costs for Tesla vehicles, solar installations, and semiconductor fabs. These costs either compress margins or pass to consumers. In a competitive market, passing costs forward is constrained by demand elasticity. If electric vehicles cost more because silver costs more, some buyers delay purchase. This slows the energy transition, which depends on silver-intensive technologies. The same logic applies to AI infrastructure. Data centers require silver in server components and power distribution systems. If silver is unavailable or prohibitively expensive, data center construction slows. This constrains compute capacity, which limits AI development. The interdependence is not theoretical. It is material and immediate. What remains is observation. Physical silver is trading at $130 per ounce in major Asian hubs. Paper silver is quoted at $71 on COMEX. The gap is $59. The gap either closes through paper prices rising or through physical prices falling. Physical prices fall when supply increases or demand decreases. Supply is constrained by Chinese policy and 5 years of deficits. Demand is driven by industrial necessity, not discretionary preference. The path of least resistance is upward convergence of the paper price. The margin hikes delay that convergence by forcing liquidation. But liquidation is a one-time event. Once weak positions are cleared, the remaining market must reconcile with physical reality. That reconciliation has begun. It will not be smooth, it will not be quick, and it will not reverse without a structural change in supply. Musk saw it coming. He said it in 3 words. The market is now pricing what he already understood. Silver is not a financial asset experiencing a speculative bubble. It is an industrial input experiencing a supply shock. The difference matters. Bubbles deflate. Supply shocks persist until supply expands or demand collapses. Neither is imminent. The next 48 hours will show whether COMEX can maintain the fiction of price discovery or whether the physical market fully decouples. If delivery requests continue at December's pace and inventories continue falling, the exchange will face a decision: suspend delivery or admit the price is wrong. Both outcomes end the same way. The paper system breaks, the physical system continues, and the entities who hold metal set the terms. That is the crisis. That is what Musk warned about, and that is what is happening now.